Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Okta.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, I have to be honest with you right out of the gate here. When I saw Okta on the schedule, I sort of let out a sigh.
Oh, yeah.
I use it every single morning. It's that little box that pops up, asks for my password, sends a push notification, and lets me into my email. It feels, utilitarian.
Like a doorman.
Exactly, a digital doorman. Are we really about to spend 15 minutes on what feels like a very expensive password manager? Is there a real wealth-building story here?
You know, if we were having this conversation 5 years ago, I might have agreed with you. Digital doorman was a pretty good description.
Right.
But if you are still viewing Okta that way in early 2026, you are missing, one of the most critical infrastructure plays in the entire market.
Okay.
We aren't just talking about logging humans into email anymore. We are talking about identity leadership on a scale that is honestly hard to wrap your head around.
Identity leadership. That sounds great on a slide deck, but what does it actually mean for the bottom line? Is this a growth story, or are we looking at a value trap?
Oh, it is absolutely a growth story. But the vector of that growth has completely shifted. This is the key aha moment for this stock.
Okay.
The biggest opportunity isn't securing you and me, it's securing non-human identities.
A non-human identity. So, we aren't talking about ghosts here, I assume.
No, we're talking about the machine economy. Think about a modern enterprise. For every one human employee, there might be 50, 100 different pieces of software.
Servers, APIs.
Servers, APIs, bots, scripts, all talking to each other. A database needs to log in to a cloud backup. An invoice bot needs permission to open a bank portal. Those are identities.
I see. So a hacker doesn't need to steal my password if they can just steal the credentials of the backup server.
Exactly. And that is what's terrifying for CIOs right now. If you leave those machine identities unsecured, your entire digital fortress has the back door wide open. Okta wants to secure that entire layer.
So their total addressable market isn't just people, it's every piece of software on.
Precisely. And the numbers from Q3 fiscal 26 are starting to show that scale.
Yeah.
We saw total revenue hit $742 million.
Okay.
That's up 12% year over year.
I'm going to stop you there. $742 million is a lot of money, sure. But 12% growth in a market where AI stocks are putting up triple digits, 12% feels a little pedestrian. Why should an investor get out of bed for 12%?
That is a fair pushback. If you're looking for a casino-style moonshot.
Yeah.
But you have to look at the quality of that revenue.
Right.
This isn't one-off hardware sales.
Right.
Subscription revenue, that's the sticky recurring money, came in at $724 million, up 11%. Yeah. But the metric I really want you to focus on is who is writing those checks.
Small businesses or the Fortune 500?
Whales. We look at customers with an annual contract value ACV of over $100,000.
Okay.
These are companies paying 6 figures a year. That number grew by over 7%. They now have nearly 5,000 of these massive customers.
So almost 5,000 companies locked in at $100,000 a year. That does suggest it's more than a nice to have. But usually when I see a SaaS company growing like that, they're just burning cash, the whole growth at all costs thing.
And that's the pivot they have executed beautifully. They went from growth at all costs to efficient growth. Their non-GAAP operating margin has expanded to 24%.
Wow. Up from what?
It was 21% a year ago.
Yeah.
So they're getting leaner and more profitable at the same time.
Margins are up. But show me the cash. Can they pay their bills?
Oh, they can pay their bills. They posted a massive free cash flow of $211 million for the quarter.
$211 million in 3 months.
Yes. That's a 28% margin. For every dollar they bring in, they're keeping 28 cents as pure investable cash.
That's a lot of dry powder, especially in this interest rate environment.
Exactly. And this is a key takeaway for anyone listening who worries about debt. Okta's balance sheet is a fortress, minimal debt. So while competitors are struggling to service loans, Okta can pour that $211 million directly into AI development.
Which brings us to the elephant in the room. Or maybe the 800-pound gorilla. Microsoft.
Knew we'd get here.
We have to. Look, my boss loves Microsoft. We use Office 365. It comes with Microsoft Entra ID. It's basically free because it's bundled in. Why would a CFO approve a 6-figure contract for Okta?
That is the single biggest bear case on the stock. Microsoft is free, so Okta is dead. But here's the counter argument, and it's why they're still winning those big contracts. Neutrality.
The Switzerland argument.
The Switzerland argument. Look, If you go all in on Microsoft security, you're handing the keys to your kingdom to Microsoft. They want to keep you in their ecosystem. But the reality of 2026 is multi-cloud.
Right. It's a patchwork quilt. You use AWS, Google, Salesforce.
Exactly. Do you really trust Microsoft to provide the best, most unbiased access to Google's tools? Probably not. Okta doesn't care which cloud you use. They're the independent platform connecting everything.
So because they don't own the data, they're trusted to secure the data.
Precisely. And that leads to stickiness. Once Okta is woven into your infrastructure, ripping it out is a nightmare. It's like trying to change the electrical wiring in a skyscraper while people are working.
The switching costs are the moat. Okay, I buy that. But let's talk about the buzzword of the decade, AI. Is Okta just slapping an AI sticker on the box? Or is there real substance?
It sounds abstract until you see it in action. They've rolled out a few things, but the game changer is a product called Auth for AI agents.
Auth there for AI agents. Unpack that for me. What does that actually look like?
Okay, imagine you're a major travel company. You build an AI agent, a bot that books complex travel for VIP clients. That bot needs to log in to the airline system, the hotel system. It needs to access credit card data.
Right, so the bot is spending money. It needs authority.
Exactly. Now, how do you secure that? Just hard code a password into the bot's code? That's a huge risk.
Oh,
Auth for AI agents provides a secure, temporary digital ID card for that bot. It lets the AI prove it's authorized, do the job, and then the session closes.
so we're moving from an internet of people to an economy of agents.
Correct. And this is the part that gets me excited for the long term. If you believe AI agents are going to proliferate, then Okta is positioning itself as the toll booth for all of that traffic.
That is a compelling narrative. But narratives don't always pay the rent. Let's look at the chart. How's the stock actually trading? Because I'm looking at the 12-month view, and it is not pretty.
It's been rough. I won't sugarcoat it. The stock is hovering around $85. Over the last year, it's down to about 15%
So it's a laggard. Why buy a laggard when you can buy a leader?
because of the divergence. This is what technical traders look for. Yes, it's down over the last year. But if you zoom in to year-to-date, just 2026, it is actually outperforming the broader software sector by almost 18%.
Wait, really? So it bottomed out and is starting to curl up?
Exactly. It tells me we are in a period of consolidation. The stock took a hit, found a floor, and is now trading sideways while the smart money starts to accumulate. It looks like a coiled spring.
I saw a headline with Jim Cramer. What was his take?
He used the word nibbling.
Nibbling, not backing up the truck.
No, and that nuance matters. Nibbling means the valuation is attractive enough to start building a position, but you aren't going all in yet. It signals the downside risk at 85 feels limited.
Okay, so the technicals suggest a bottom might be in. What about the vibe on Wall Street? Are analysts on board?
The sentiment is what I'd call neutral to bullish. Most analysts have buy ratings, but here's a data point I love. The Zacks consensus earnings estimates what the pros think Okta will earn actually went up by 2.1% on the last 30 days.
That's interesting. So the price is choppy, but experts are quietly raising profit expectations.
Exactly. That is a bullish divergence. Price follows earnings. And we're seeing real-world proof. Look at the recent partnership with the PGA.
The Professional Golfers Association.
The one and only. Okta is now handling identity for over 30,000 users across the PGA ecosystem.
I mean, that's cool, but is securing a golf tournament that hard?
Think about the complexity. You have full-time staff, thousands of temporary volunteers, media partners, players, agents. The turnover is high, the access levels vary wildly, and it all has to work on a golf course.
Okay, when you put it that way, it's a logistical nightmare.
It is. And the fact that the PGA trusts Okta with that mess is a massive proof of concept for other big enterprises.
It's a brand name win, helps the story. I also noticed some movement in the boardroom.
They added Rob Bernstein and Paul Sagan to the board.
Why should the average listener care about board members?
In this case, it signals maturity. These are heavy hitters with deep experience scaling large tech companies. It tells the market that Okta isn't a scrappy startup anymore. They're preparing for the next phase of scale.
Okay, let's get tactical. Today is February 16th, 2026. If I'm a trader, what's the date I need to circle in red?
March 4, 2026.
Earnings day.
That is the big catalyst. Q4 and full fiscal year 2026 results post-market.
And what are we expecting? The whisper numbers.
Company guidance is for revenue between 748 and 750 million. So about 10% growth. And for the bottom line, non-GAAP EPS of roughly 84 to 85 cents.
So consistent, profitable growth.
Yes. But the real spark is the macro environment. We're seeing a sector rotation into cybersecurity stocks that are resilient to AI. Plus, we have expectations of rate cuts coming down the pipe.
And lower rates are like rocket fuel for software stocks.
Exactly. If Okta hits those numbers on March 4th and gives a solid outlook, this stock could break out of its consolidation pattern very quickly.
Sounds like the stars are aligning, but I have to play devil's advocate. Why would someone not buy this stock? What's the bear case?
You have to look at the downsides. Two main risks. First is valuation. Even at 85, their value score is a D.
A D? That sounds terrible.
It just means the stock isn't cheap by traditional metrics. You're paying a premium for that Switzerland neutrality. If growth slows down to single digits, that premium might not seem worth it.
So they have to keep running just to stay in place. What's risk number 2?
Competition. We talked about Microsoft, but there's also Palo Alto Networks and SentinelOne. Their pitch is platformization. They say, we already do your firewall. We'll throw an identity for cheap if you bundle with us.
The classic bundle versus best-of-breed war.
It is. However, and here's why I'm still bullish, Okta has a massive safety buffer. The backlog.
How big of a buffer?
We call it RPO, remaining performance obligations. It's the total value of signed contracts that haven't been billed yet. That number is up 17% to $4.29 billion.
Billion with a B.
$4.29 billion. It's a guaranteed future paycheck. That protects them from sudden shocks.
That is a pretty comfortable safety net. Okay, we've stripped it down. It's time for the final verdict. I need a score out of 10 in your elevator pitch.
I'm giving Okta a bullish score of 8 out of 10.
An 8? That's high conviction.
It is. Here's the pitch. You have a company with 12% revenue growth that's aggressively expanding margins. They are generating massive cash flow, and they have a legitimate defensive moat. It's a resilient leader in cybersecurity.
And the trade.
At 85, it looks undervalued. My strategy here is a swing trade into the Q4 earnings on March 4. I think the setup is there for a pop, but beyond that, I see potential for a multi-year hold. The AI agent story is going to play out over 5 to 10 years, not 5 weeks.
So buy it for the earnings pop, keep it for the robot revolution.
That's a play.
I like it. So to recap, strong identity play, robust cash flow, and a huge earnings date 2 weeks away on March 4. A stock that's taken a beating but seems ready to get back up.
Absolutely. And before we go, I want to leave you with one final thought.
Hear me.
We talked about non-human identities. Right now, it sounds niche. But imagine a world 5 years from now where AI agents outnumber human employees 100 to 1.
A completely digital workforce.
Right. In that world, the entity that controls the identity of those agents, the one that says, yes, this bot is allowed to access the bank account, that entity effectively controls the economy.
It stops being IT support and starts being the central nervous system.
Exactly. Securing humans is valuable. But securing the AI workforce might eventually become the most valuable real estate in software. So we have to ask, is Okta becoming the passport control for the global AI economy?
That's a heavy thought. The passport control for the AI workforce. I'll be thinking about that. Thank you for breaking it down.
My pleasure.
And thank you for listening to Smart Wealth with Joshua. We'll catch you on the next one.